They say trading options is simple. They say just follow the setups, manage your risk, and profits will follow. They say the market is fair if you stick to the rules. You've heard it from forums, YouTube channels, newsletters, and even mentors promising you the perfect system. Phrases that sound like wisdom, that feel safe, that convince you discipline alone will protect your account. But those words, as innocent as they sound, are only half the story. While retail traders focus on charts, indicators, and setups, the real market is playing a game most people don't even see. And that's why so many options traders vanish overnight, leaving others wondering what went wrong. Imagine a trader named Jason. Jason spends hours every day analyzing option chains, scanning implied volatility, marking support and resistance, noting key strikes, and backtesting strategies meticulously. On paper, he looks like the perfect retail trader. He has solid setups, a disciplined plan, and he journals every trade. But despite all that, after a few months, Jason's account disappears. Not slowly, suddenly. One day it's green, the next day wiped out. And when you ask why, no one gives a straight answer. Some say it's luck. Some say he was reckless. The truth is far more subtle and far more dangerous. Options markets are not linear or forgiving. Every strike price, every expiration, every implied volatility figure is part of a vast ecosystem controlled by institutions, hedge funds, and market makers. While Jason focuses on entry points and setups, these big players think in layers. They think about delta, gamma, theta, vega. They think about how to create conditions where retail traders get trapped. Retail traders provide the fuel, and the market's bigger players feed off it. The irony is that Jason is skilled. He knows technicals, understands momentum, and even predicts some short-term swings correctly. Yet every time he thinks he's winning, he's just one step behind the invisible currents that guide options prices. One sudden adjustment in a large institutional position can ripple through the market, moving implied volatility, affecting premiums, and suddenly everything he thought was safe is gone. His stops get hit, margin calls appear, and in moments, months of disciplined work vanish. It's not failure in skill, it's failure to understand the deeper mechanics. After a few small wins, Jason grows confident. He starts adding to positions, believing he has cracked the market's code. But each incremental bet magnifies exposure, and fear and greed take over. That's exactly what institutions count on. Retail traders will over-leverage, overextend, and ultimately panic. When the market moves against them, disappearance isn't gradual, it's explosive. The market itself is designed to create these moments. Every options expiration is a story of accumulation, distribution, and manipulation. Large players anticipate the herd's behavior. They know where retail positions are clustered, where stop losses sit, and where the majority is likely to panic. When the market sweeps those clusters, it doesn't just move prices, it wipes out accounts, creating the sudden disappearances you hear about in forums and chat rooms. Those moments feel random, but they are meticulously orchestrated by forces most traders don't even understand. Consider volatility. Jason might think he's managing risk by following setups with strict stops and fixed position sizes. But options are dynamic. Vega moves with fear, gamma shifts with hedging, and theta decays silently. A minor move in the underlying stock can create massive ripples in premium pricing. When the market reacts faster than Jason can adjust, his perfect setup becomes a trap. Every technical edge he thought he had is neutralized by invisible hands guiding the market. Diversification and hedging give a false sense of security. Jason spreads trades across multiple strikes or different expirations, thinking he's covered. But institutions think probabilistically. They calculate expected retail behavior across thousands of contracts and know how to push clusters into margin calls while benefiting from the flow. Diversification only protects the uninformed. Awareness protects the informed. Most retail traders never reach that level, which is why so many vanish quietly, never to return. It's easy to blame strategy, poor planning, or luck, but the deeper truth is uncomfortable. Options trading is not about executing the perfect trade. It's about understanding who controls the playground, how they move the pieces, and why retail behavior matters to them. Without this awareness, no amount of technical skill or disciplined journaling can prevent disappearance. Every account wipe tells the same story. The market is bigger, smarter, and faster than you think. If you watch closely, you'll see patterns. The trades that disappear are clustered around predictable human behaviors, chasing momentum, over-leveraging small wins, panicking at the first red candle. Successful traders, the ones who survive and grow, don't necessarily have perfect setups. They have understanding. They understand the mechanics behind options, the invisible flows of liquidity, and the psychology of the crowd. They know when to step aside and when to engage. Disappearing accounts are warnings, not mysteries. The market doesn't punish skill or discipline. It punishes misunderstanding. It punishes those who follow formulas blindly, who think risk can be quantified in percentages alone. The market rewards insight, adaptability, and a deep understanding of hidden layers most tutorials never mention. That is the fundamental divide between traders who vanish and traders who thrive. It's not talent, it's context. The next time you hear about a trader who vanished overnight, don't assume incompetence. Assume they were caught in forces they couldn't see, forces of liquidity, volatility, and human behavior intertwined in ways no chart could fully explain. Disappearance is not failure. It's a symptom of a deeper market reality. The difference between surviving and vanishing is not luck. It's insight, timing, and awareness of the invisible game being played around you. Every trade carries a lesson if you pay attention. Each margin call, each unexpected loss is a signal from the market telling you where your understanding is incomplete. The traders who return, who grow, are the ones who learn from these signals. They don't just survive, they adapt, they evolve, they anticipate. They learn the rhythm of the market, the subtle push and pull of options mechanics, and the psychology of retail behavior. They don't disappear, they dominate. Now let's go deeper into the psychology of disappearance. Retail traders are often unaware of how deeply emotion influences every decision. The first loss after a string of wins feels unbearable. The first margin call feels catastrophic. The fear of missing out pushes them to chase moves that are already overextended. And when the market reacts unexpectedly, the mental shock compounds with financial loss, creating a spiral that leads to sudden exits, or worse, total wipeouts. Experienced traders recognize that emotional control is as important as technical skill. They don't just react. They anticipate, pause, and position themselves in ways the herd never considers. Options markets are cyclical, and every cycle has invisible traps. Institutions know where retail capital is concentrated, and they design moves to exploit it. Every unexpected volatility spike, every sudden price swing is a test, a filter to see who will survive and who will disappear. Retail traders, operating without this understanding, get swept up like leaves in a storm. Their accounts vanish, not because they are incompetent, but because they never saw the storm forming. Even sophisticated strategies can fail if they ignore context. Covered calls, spreads, straddles, iron condors, all of these can seem safe in isolation. But the market doesn't operate in isolation. Liquidity shifts, implied volatility changes, and institutional hedges move the goalposts constantly. Traders who ignore these layers, no matter how disciplined, risk sudden losses that wipe out months of gains. Awareness of market mechanics, timing, and crowd behavior is what separates survival from disappearance. Disappearance is also a social phenomenon. Traders who vanish often stop sharing, stop communicating, and retreat from the community. Their silence becomes a warning sign for others, though few understand its meaning. The market doesn't care about stories or reputations. It only reacts to positions, liquidity, and flow. Understanding this is crucial. Real traders watch not only charts, but the behavior of other participants, spotting where risks are concentrated and where opportunities are hidden. The market doesn't punish traders for losing money. It punishes traders for misunderstanding structure, psychology, and liquidity. Disappearance is not the end. It's a lesson. Those who study these lessons, who analyze why accounts fail, who watch patterns over time, are the ones who develop a skill no indicator can teach: the ability to anticipate moves before they happen. They learn to survive, to grow, and to dominate. The difference between traders who disappear and those who thrive isn't luck. It isn't even skill alone. It's perception, insight, and the ability to navigate layers invisible to most participants. The vanished traders are a reminder of what happens when technical skill meets incomplete awareness, when discipline meets unrecognized risk, and when confidence meets forces beyond comprehension. If you want to learn how institutional players think, how they manipulate liquidity, and why some traders disappear while others thrive, go check out the other videos on this channel. And if this video opened your eyes, hit the like button, subscribe, and leave a comment sharing a moment when you realized the market was smarter than you. Here at Profit Pulse, we don't just follow trades, we decode the invisible forces behind them.